Okay, let's cut to the chase. Why are stock futures slipping tonight while oil prices spike? The headlines say it's about the Strait of Hormuz, but let's dig deeper because the real story here is way more fascinating. Here's the setup. The S&P 500 futures are down 0.2%, Nasdaq barely holding, and Dow plunging. But get this, the market just hit all-time highs last week. So what's the deal? Are traders suddenly panicking over Middle East tensions? Or is there a bigger game being played here? Let's unpack this like a pro. First, the Strait of Hormuz drama. You've heard it's a critical waterway. But why? Well, 20% of the world's oil passes through this 2-mile-wide chokehold. Iran says negotiations with the US are fake news, but Trump's own Treasury Secretary Scott Bessent claimed a deal was imminent days ago. Contradictions? Absolutely. And that's the point. Markets hate uncertainty, but they really hate political theater. Here's what's interesting. This isn't just about oil. It's about trust in global trade routes. If Iran starts flexing muscles here, every shipping lane from the South China Sea to the Black Sea becomes a question mark. But here's the twist. I think traders are using this as an excuse to cash in gains after a red-hot July. Why? Because the real monster under the bed isn't Iran. It's inflation data coming this week. Wait, let me explain. The jobs report dropped last week showed fewer workers employed, which weirdly spiked hopes for a Fed rate cut. Now, 44% chance of a September hike? Down from 67%. Sounds good for stocks, right? But my gut says this is dangerously short-sighted. Lower employment means weaker consumer spending, a massive problem since 70% of the US economy relies on people buying stuff. Think about that. The market's rally is built on the idea that less growth equals more liquidity. But what if that liquidity is masking rot in the real economy? Peter Graff from Amova calls this out, but let's take it further. If companies like On Holding or Super Micro report weaker earnings this week, we'll see if the dovish Fed narrative holds up. Now, let's connect the dots. Why does a Strait of Hormuz deal, or lack of one, matter more now? Because oil prices at $79 a barrel are a Goldilocks number. Too low, and energy stocks tank. Too high, and inflation spirals. Right now, it's a tightrope walk. But here's what most analysts miss. This isn't just about supply chains. It's about perception. When Trump says the US is only semi-negotiating, he's signaling unpredictability, a weapon he's used since 2016. Markets hate that. It's why the S&P 500's record highs feel so fragile. We are in a world where geopolitical chaos is priced in at a discount, but one wrong move and that discount vanishes. So where does this leave us? Watching CPI data like hawks this week, but honestly, I'm more intrigued by the cognitive dissonance here. The market just had its best week since April, yet we are one bad inflation print from a sell-off. One missed earnings call from a tech darling like CoreWeave and the whole AI-driven rally story collapses. This isn't a correction waiting to happen. It's a Rorschach test. Bulls see dovish Fed moves. Bears see a jobs market cracking under pressure. And the Strait of Hormuz? It's the perfect plot device to justify whichever way this breaks. Final thought. What if the real takeaway isn't about stocks or oil, but about how we've normalized volatility? Think about it. Record highs amid Middle East brinkmanship, shaky jobs data, and inflation crosshairs? That's not confidence. That's collective whistling past the graveyard. What do you think? Drop your takes below. Let's see if we can spot the next pivot point together.